We started doing a lot of work on portfolios a couple of years ago on how to position portfolios for the medium and long term. Now, these are long-term portfolios. These aren't trading portfolios. You're not going to double your money in a year. These are portfolios for people's wealth and their families' wealth for 20, 30, 40 years. So we're thinking long-term. We're not here in a position here to say whether temperatures will rise by 1 degree or 3 degrees or 5 degrees or -2 degrees. We're not here in a position to say that we think humans are doing this or not, or coal is good or bad. Everyone has a view on that, and everyone has a view about how to respond to that. We, in a portfolio, we have to basically look at the financial outcomes, and we have to look at risks. We look at risks from inflation, we look at wars, we look at revolution, we look at deflation, we look at economic growth, we look at so we look at all the risks in a portfolio. One of the risks in portfolios for investors is going to be climate change. So for investors, we need to think about the impact of those sorts of activities on investment returns, which is it's very hard to model, but it's certainly there are paths through the thinking on this. So, for example, fossil fuels currently power the world, have done for a century in various forms: transport, electricity, etc. There is no doubt a move away from fossil fuels to more sustainable sources of energy. We're talking basically coal, oil, and gas, the big ones. Now, some companies, and there are companies that have done very well over many, many years. ExxonMobil, for example, was the biggest company in the world for many, many years, biggest American company. It is now out of the top 10, and it's getting smaller, even though it's had a great year. Some companies, these companies will have to deal with a lot of issues, and some companies, for example, they've got to invest heavily in renewable sources. Some are doing better than others. Some are ignoring it. Some are ditching old sources and going to new sources totally. So some companies will completely die. Like in every industry that goes through changes, competitors die.
Yeah, so it's a fundamental structural change for that whole sector coming up.
In its place, there'll be new companies we don't even know about today that'll come out. You know, Tesla didn't exist 10 years ago. Google, Facebook didn't exist. So there'll be new companies that don't exist today that will take over and lead the world in the decades to come. Our fear is that a lot of the old companies, and not just the oil and gas, fossil fuel, coal producers, but a lot of spin-off industries, a lot of related industries, a lot of supplier industries with those, will be hit with a lot of costs: remediation costs, cleanup costs, taking down wasted assets, stranded assets. Look at BHP's got all these BHP operations in the Bass Strait. They're going to have to be taken down. They've flicked past those to Woodside to clean up. So various companies are going to be in a lot of trouble. You look at all the oil and gas spills over the last 10, 20, 30 years, the massive Exxon Valdez type spills, the Deepwater Horizon spills, those cost tens of billions of dollars to clean up. So some of those companies will be crippled and die, disappear, just like in every industry, companies die. Other companies will come into their place. So we can see that as an industry, the fossil fuel industry is likely to underperform in financial terms for those reasons alone: the sheer cost of transition, the sheer cost of change, the sheer cost of undoing the messes they've created, filling the holes, taking down the oil rigs. It's going to be horrendously expensive, far more so because there's more regulation around how you do that. You can't just blow something up. You've got to take it apart piece by piece and redeploy it. So very expensive. So in portfolios, we have a lot of assets in portfolios. We have shares, we have property, we have cash, we have bonds, we have commodities sometimes. Every one of those is affected differently by climate change as a risk factor. In the case of shares, which are more easy to understand because you're dealing with companies that do things, that use power, that produce products, we have they come in two flavors in our portfolio. One flavor is active funds. We have 3, 4, 5 active managed funds. So
you've got a portfolio manager there making a decision of what you choose to invest or not invest in. So there's sort of a human overlay with support teams and other things.
And then you have passive funds, which are index funds, low-cost index funds, Vanguard funds, iShares funds, etc., VANEC funds. Now, we're treating those differently because the decision-making processes are different. In the active funds, every fund manager now has to report on their carbon intensity, their carbon emissions of the companies in their portfolio, and they're very careful about how they manage those and manage those risks, including the risks of remediation, the risks of transfer, of transitioning, etc. So we've got a process to get inside the active fund managers to understand how they manage risks. So we're doing that anyway. Where it's different altogether is the passive funds, which are the Vanguard funds. And we have these in portfolios primarily as tactical holdings, low-cost holdings in order to do our tactical changes. Some of those are core holdings. And for low-cost exposure, we are shifting from, now, the problem with the passive fund is when they go for, say, global shares or US shares or UK shares, their job is to buy everything willy-nilly regardless.
You buy the index, therefore, whether you like it or not, if it's in the index, you get it in the...
So the index has 4,000 companies, you get a piece of all 4,000 companies.
So as you would have described, 10, 15 years ago, the major energy companies would have made up the large chunk of the top 10. And if you had an index holding, you would have owned them all.
That's right. Right. So in our current funds and index funds and portfolios, we are shifting from, for the core fund in our international share portfolio, we are in this cycle, we're shifting from a fund that buys everything, good or bad, to a fund that is filtered. It's got some filters on it, I'll describe it in a second, but it also, the major one being, it eliminates almost all of the fossil fuel exposure in portfolios. So, for example, fossil fuel producers currently make up about 3% of the population of the global market value of companies worldwide. The ExxonMobil, Shell, BP, etc., Chevron, also BHP, Rio, they're big coal producers, Woodside, Santos, etc. They only make up 3% of the current value of portfolios, which is a lot less than it was 20, 30, 40 years ago. But it has the capacity to make enormous losses. So if you look at the losses in 2015-16, we had an earnings recession globally. Every country in the world had an earnings recession, not an economic recession, an earnings recession. Corporate profits went down. That was purely to do with oil and gas and steel losses in the energy industry. So even though it's only 3% of the market, it has the potential to damage portfolios irreparably. So we have taken out those oil and gas and coal stocks in our index fund we've selected for the global share portfolio. That'll reduce the carbon emissions, the CO2. Now, the good thing about that, there's lots of measurement systems and reporting systems, and they all have to measure and report on these so we can tell what they do. So currently, the typical global share portfolio emits around about per $1 million of investment. If I invest $1 million in this fund, I am responsible for about 230 tons of carbon emissions per year. That's a lot. 230 tons is a lot of in the atmosphere. So as an investor with $1 million, $1 million has bought me a list of companies which emits 230 tons. And about 1,900 tons of reserve emissions, which is the reserves under the platforms in the ground or under the coal mines, which they will at some time in the future exploit. By shifting to this low carbon emission, fossil free portfolio, it basically reduces the carbon emissions today by about 20% across the board. And it reduces the carbon reserve emissions, which is the yet to be polluted emissions, by about 99%. So it goes from about 1,900 tons of carbon emissions per year to around about 6, which is just a residual amount. So by doing that in one fell swoop, we take away the fossil fuel producers from portfolios, and we reduce by about a quarter the carbon footprint of the portfolios, which is pretty good. Yeah. The downside, of course, is if you go through the list of stocks, all of a sudden you have no ExxonMobil, you have no Chevron, you have no Aramco Saudi, you have no. Now, the financial impacts are paramount. Oil and gas stocks and coal producers, energy stocks in general, by and large have underperformed the global market, but it depends on the period. If you pick a period where oil prices have risen, like this year, oil and gas stocks, coal stocks do very well. So if you look around the world this year, you've got all the oil and gas stocks up 30 or 40%, pretty much across the board, including Australia up 10, 20, 30% as well. When oil prices are flat or negative, which is our long-term outlook for oil and gas, as it goes out of favor and is replaced by better methods, then they will return to a situation where the old energy companies, if they don't transition well, and if they die or fall by the wayside, then they will underperform the index, which it's done for decades. So it's a question of timing.
I guess what you're saying there is the timing to implement a filter such as this on portfolios is somewhat fortuitous because they've had a strong year in terms of recovery in their prices.
That's right.
Yeah.
Yeah. So we didn't pick the timing, and nor should you try. But this is a long-term trend, a long-term issue we're dealing with here. It just happened to be not a bad time to get out of oil and gas because it happens to be a year they've had, which is good. I mean, oil prices have doubled this year. They went from negative last year or zero last year. They're now back to $80. Most of this gets back to the inflation debate with central banks. Most of the energy crisis we're seeing, particularly in the Northern Hemisphere with blackouts and factory shutdowns and supply chain problems, a lot of that is to do with, in fact, most of it's to do with supply constrictions, partly OPEC, but most of it's to do with things like COVID lockdowns affecting ports and affecting operations. So the oil price being $80 plus today compared to half this time last year and negative a year and a half ago, a lot of that will start to ease as we get into next year. So we're not seeing another 5 years of oil price rises. Probably it's actually not a bad time to make that call. It's pure luck as it turns out, but it's not a bad time to do it.
So let's just, there's many elements to that. So if we can, I'm just going to reiterate some of it and just for the listeners. At the minute, we are looking, this is impacting the exposures we have in the index or the passive sleeves to our portfolios. So where we'd previously used broad index managers such as Vanguard, we're going to select variants of that have a filter on it that is going to basically screen out those exposures to those fossil fuel type providers. And we are doing that essentially because we feel medium to longer term investment wise, that will create a better, superior investment performance. And also potentially, obviously, you get the additional benefit of it's going to have a lower carbon footprint. At this point, we are starting to do that review purely on the international equities. And that's one that we are going to implement in portfolios in the next week to 10 days. And we will then revisit that across Australian equities and other sectors over time in the near term future as we build out, I guess, this methodology across the entire portfolio.